We are auditing the institutional data behind Deepak Nitrite's current expansion. To understand their position in the chemical sector, we have to look at how they are capturing the massive addressable market created by global China Plus One supply chain shifts. Right now, this business trades at a market capitalization of roughly 22,500 crore rupees. But looking closely at their numbers reveals a severe split between how the market values their legacy operations and the reality of their future state. To break this down, we divide the company into three distinct revenue pillars. First is the standalone advanced intermediates business. Second is Deepak Phenolics. And third is the newly formed Deepak Chemtech, or DCTL. The standalone bucket alone gives them a structural moat. They control a massive 75 to 80% domestic market share in key chemicals like sodium nitrate and fuel additives. In the Phenolics division, they hold a 60% market share in phenol. Controlling that much volume makes them the lowest cost producer in the country, insulating their margins when the broader sector faces headwinds. That deep backward integration creates a highly protective baseline. Even during severe industry downturns, their scale allows them to maintain a solid 15% return on capital employed. Yet management is executing a 5-year growth plan that completely reshapes the company. They have committed to an aggressive 14,000 crore rupee capital expenditure cycle. Looking at this CapEx guidance document, you can see the scale of this investment. Their current net fixed assets sit at roughly 2,500 crore. This new deployment represents a 5.6 times increase in fixed assets by FY28. That capital goes directly toward aggressive forward integration. They are building large-scale import substituting capacities for polycarbonates, MIBK and MIBC, to supply the domestic market. To fund a transition of this magnitude, the legacy operations have to generate heavy cash flow. We can see exactly how they are managing this right now in their latest third-quarter results. The Q3 consolidated profit after tax came in at 219.83 crore rupees. That represents a 120% quarter-on-quarter jump. That jump materialized through stable domestic demand. Export revenues remained depressed, making up only 17% of total sales for the quarter. They are mitigating the ongoing threat of Chinese chemical dumping through a diversified base of over 1,500 clients, paired with a high DJSI sustainability score of 67, which secures long-term institutional contracts. This creates a clear paradox. The market is pricing Deepak Nitrite strictly on the cyclical struggles of a legacy chemical supplier. It is assigning almost zero value to a high-tech polymer powerhouse that will be nearly 6 times larger in 3 years. To understand why the market is discounting that future growth, we need to audit the financial damage from recent macroeconomic shocks. Over a 3-year period, top-line revenue grew from 68,000 million to nearly 83,000 million rupees. But this chart shows severe margin compression. Raw material inflation and Chinese dumping squeezed EBITDA margins down from 24% to around 12%. Despite this, their EV to EBITDA ratio remains near its historical average. The market has priced in the worst, projecting a slow recovery through FY28. We also need to check the balance sheet's capacity to absorb debt. Their historically conservative capital structure means their debt-to-equity ratio remains entirely manageable, even as they draw down funds for construction. If you look at their PEG ratio today, it appears heavily inflated. However, that metric is skewed by the recent cyclical profit degrowth. Measured against their forward earnings potential, the valuation is highly attractive. The cash flow mechanics remain stable. Return on capital employed has leveled out at 15%, and they maintain excellent CFO to PAT conversion. You should expect free cash flow to remain negative in the near term, simply because of the 14,000 crore cash outflow required for expansion. The evidence indicates that while the profit margins took a severe beating, the underlying balance sheet structure is easily strong enough to finance their massive expansion costs without breaking. Moving to operational liquidity, there is clear stress on the working capital cycle. It has become visibly stretched over the past year. This stretch is driven directly by rising inventory levels and extended debtor days, a consequence of weak export demand across the global agrochemical and textile sectors. When working capital tightens, we check management stability. Promoter pledging remains at 0%. Next, auditor fee increases are strictly proportional to profit growth. Finally, historical capital allocation is highly efficient, generating over 3 rupees for every rupee invested. This history of efficient deployment is why they are aggressively pushing forward integration now. They are attempting to detach their cost structure from the volatility of crude-linked feedstocks. These core governance indicators do not show structural red flags. The data suggests that the current earnings step is a cyclical downturn, rather than the result of internal accounting issues. We can further validate this stability by comparing Deepak Nitrite against peers like Vinati Organics and Atul using the Altman Z-score. Deepak posts a Z-score of 7.17 that firmly places them in the high safety zone regarding bankruptcy risk, even with the near-term leverage added by the capex cycle. Shifting to technical analysis, the stock is currently trading around 1,651 rupees. It's consolidating well below its 52-week high of 1916 and bouncing off a low of 1280. The critical trigger on the charts right now is a golden crossover, which has materialized on both the daily and weekly timeframes. When short-term daily moving averages cross above a long-term 150-day moving average, it serves as a classic institutional indicator. It signals that long periods of consolidation are breaking and a long-term trend reversal is underway. For the first time, technical momentum is finally aligning with the fundamental reality that the absolute worst of the chemical down cycle is behind them. Let's lay out the valuation matrix. In our bear case, Chinese dumping persists, the capex execution faces severe delays, and the stock stagnates near its established floor of 1,400 rupees. In the base case, margins normalize back to the 15 to 16% range, and construction executes on time. This drives the stock toward the analyst consensus target of 2,650 to 3,000 rupees. In the bull case, Varying polycarbonates and specialty chemicals dominate the domestic import substitution market, pushing return on capital employed back above 20%. If the company achieves a baseline 15% compound annual growth rate over the next 5 years, the total return profile becomes highly compelling for long-term holders. Because right now, the market is completely ignoring the massive earnings per share boost that will come online as the new plants become fully operational. Buying shares today means you're paying a fair price for their existing 9 to 10,000 crore business, while acquiring their future 14,000 crore asset base essentially for free. Our final verdict on Deepak Nitrite is a strong buy on dips or hold for investors operating with a strict 5-year time horizon. Near-term volatility in the global chemical space is guaranteed. That the asymmetric risk-reward profile here offers a rare, highly lucrative entry point into a company preparing to scale its production capacity by nearly 6 times.